I want to begin by acknowledging something that rarely gets said out loud, especially in markets that never stop talking. What you're feeling right now isn't panic. It isn't fear in the dramatic sense. It's exhaustion. It's the quiet tiredness that settles in after months and years of waiting, watching, hoping, checking, doubting, and then pretending not to care anymore because caring started to cost too much energy. It's the boredom that comes from sideways movement. It's the mental fatigue of seeing the same discussions repeat, the same arguments recycled, the same optimism rise and fade without resolution. And if you've been holding XRP through long stretches of silence, slow progress, repeated dips, and delayed validation, there is nothing foolish or weak about feeling this way. This kind of market environment wears people down not with violence but with monotony, not with crashes but with time. Most people assume that investors break during sharp drops, during moments of obvious chaos, during days when everything feels like it's falling apart. But that's not what truly empties people. What drains conviction is the endless in-between, the days where nothing happens, the weeks where price goes nowhere, the months where progress feels theoretical instead of real. It's the sense that life is moving forward everywhere else while this one decision seems frozen. That's what creates doubt. That's what makes people quietly question themselves late at night. And if that's where you are right now, I want you to know that this state is not a sign that you were wrong. It's a sign that you are being tested in a way most people never expect. Markets don't just test capital, they test nervous systems, they test patience, they test identity, they test whether someone can hold a position emotionally long enough for reality to catch up. And most people don't lose because their thesis was flawed. They lose because emotional fatigue convinces them to exit at the exact moment when nothing feels worth waiting for anymore. Exhaustion creates urgency. Urgency weakens judgment, and weakened judgment leads to decisions that feel relieving in the moment but expensive in hindsight. There is something important to understand about environments like this. Sideways markets are not neutral. They are active psychological filters. They are designed, intentionally or not, to remove participants who require stimulation to stay committed. When price isn't moving, when narratives are stale, when excitement has dried up, attention leaves. And when attention leaves, discipline is all that remains. This is where the difference between short-term retail psychology and long-term capital psychology quietly reveals itself. Most long-term investors assume that fear is what eventually forces people out of markets. But in reality, fear is loud and short-lived, while exhaustion is quiet and far more dangerous. Emotional exhaustion doesn't arrive in a single dramatic moment. It builds slowly through repetition, through days that look the same, through charts that move sideways, through hope that never quite turns into confirmation. Over time, the mind stops reacting sharply and instead grows tired, bored, and disengaged. That state is where conviction quietly erodes. You don't panic. You don't rage. You simply start wondering whether any of it was worth it. For many XRP holders, this is the real psychological pressure point. Not volatility, not crashes, but the slow grind of waiting without reward. This kind of exhaustion creates a unique form of doubt. It doesn't shout that you're wrong. It whispers that you might be wasting time. It makes you question not just the asset, but your own judgment, your patience, and your intelligence. And because nothing dramatic is happening, it feels harder to justify staying mentally invested. The human brain is not built to sit calmly in uncertainty for long periods without stimulation. When markets stop providing feedback, the mind fills the gap with self-criticism. That's why sideways markets are more damaging to conviction than sharp drops. A crash is painful, but it is honest. It gives you something clear to react to. Exhaustion, on the other hand, slowly drains meaning from the decision itself. What's important to understand is that feeling tired does not mean the decision was wrong. It means time is doing what it always does to human psychology. Time stretches emotions. It magnifies doubt. It turns patience into discomfort. And most people are never taught how to manage that phase. They are taught how to buy excitement and how to react to fear, but not how to sit with boredom and stillness. As a result, many exits happen not because of new information, but because the nervous system can no longer tolerate the waiting. This is where many investors misunderstand their own behavior. They believe they are making a rational choice when they finally step away, but often they are simply seeking relief. Relief from checking prices, relief from uncertainty, relief from the quiet pressure of feeling stuck. That relief feels good in the moment because tension disappears, but it is not the same as strategy. Strategy is deliberate and calm. Exhaustion-driven decisions are reactive, even if they feel peaceful afterward. Markets have always taken advantage of this human limitation. Long periods of inactivity are not accidental. They naturally push out participants who rely on emotional engagement to stay committed. The longer nothing happens, the more people reinterpret waiting as failure. Yet, historically, these are the very conditions where positioning quietly shifts, not because outcomes are guaranteed, but because patience becomes scarce. Understanding this changes how you relate to your own fatigue. Instead of seeing it as a signal that you were wrong, you can recognize it as a predictable psychological response to time. That recognition alone restores some control. You stop personalizing the market's silence. You stop assuming that your tiredness is evidence of poor judgment. And you begin to separate emotional discomfort from analytical reality. This does not mean forcing yourself to feel optimistic. It does not mean suppressing doubt. It simply means acknowledging that exhaustion is part of the process, not proof of failure. When you understand that, you are less likely to let temporary emotional depletion decide the fate of a long-term position. You regain the ability to pause, to step back, and to choose clarity over relief. And in markets, that quiet ability to endure without reacting is often what separates those who survive cycles from those who exit them just before conditions change. Most people believe that investing is primarily an intellectual exercise, that success comes from being smarter, faster, or more informed than others. In reality, markets rarely defeat people through lack of knowledge. They defeat people by overwhelming the nervous system. The constant flow of information, price updates, opinions, and speculation keeps the mind in a state of low-level stress. Over time, this stress accumulates and quietly degrades decision-making. You may still understand your original reasoning, but you no longer feel steady inside it. That internal instability is far more dangerous than being wrong on analysis. When the nervous system is overstimulated, patience disappears. Every small price movement starts to feel meaningful. Every delay feels personal. The mind shifts from long-term thinking to short-term survival mode without conscious permission. In this state, urgency replaces clarity. You feel the need to do something, anything, just to regain a sense of control. This is where many decisions are made that later feel confusing or regrettable. They were not the result of new insight, but of emotional overload. Constant monitoring accelerates this process. Checking price repeatedly does not provide more understanding. It trains the brain to seek constant feedback. Each glance becomes a micro-stress test. Over weeks and months, this habit keeps the nervous system activated even when nothing meaningful is happening. Eventually, the body interprets waiting as threat. Fatigue sets in, confidence erodes, and decisions become reactive instead of intentional. This is why emotional regulation is not a luxury in markets, but a necessity. The ability to remain calm during uncertainty is not about suppressing emotion, but about preventing emotion from hijacking judgment. Long-term capital understands this instinctively. It does not live inside every candle. It does not require daily validation. It creates distance between information and reaction. That distance is where rational thinking survives. Retail psychology often mistakes activity for progress. When nothing is happening, it feels unsafe. Silence feels like danger. Yet in many cases, silence is simply a phase of compression. The market is not asking for interpretation, but for restraint. When investors cannot tolerate stillness, they manufacture urgency. They search for reasons to act even when no action is required. This is how nervous system overload leads to misalignment with original intent. What began as a long-term position slowly turns into a source of daily stress. The time horizon shrinks, the focus narrows, and eventually the decision to exit feels like relief rather than strategy. That relief can be mistaken for clarity, but it is often just the absence of tension. Understanding this dynamic gives power back to the investor. When you recognize that your discomfort is physiological as much as psychological, you stop treating it as information. You realize that the urge to act does not always come from insight. Sometimes it comes from fatigue. Sometimes it comes from overstimulation. And sometimes it comes from the simple human inability to sit calmly in uncertainty for extended periods. This awareness allows you to slow the process down, to pause before reacting, to reduce inputs instead of increasing them, to remember that not every moment demands engagement. Markets reward those who can remain internally stable when external signals are quiet or confusing. None of this guarantees outcomes. Calm does not ensure success, but reactivity almost guarantees mistakes. When the nervous system is regulated, decisions reflect understanding rather than stress. And in environments defined by waiting, uncertainty, and delayed resolution, that internal steadiness becomes one of the most valuable assets an investor can possess. Sideways markets are often misunderstood as periods where nothing meaningful is happening, but in reality, they are doing very specific work on investor psychology. When price stops moving in obvious directions, it removes the emotional signals people rely on to stay engaged. There is no excitement to reinforce belief, and no panic to force immediate action. What remains is time, silence, and uncertainty. This combination slowly pressures participants to reevaluate not just the asset, but their own patience. Many beg to interpret inactivity as failure even though no new information has actually appeared. This environment acts as a psychological filter. Investors who need constant stimulation, reassurance, or momentum to remain committed begin to disengage. Their conviction was never built for quiet. It was built for motion. As the weeks and months pass without clear progress, attention drifts elsewhere. Doubt grows not because the situation has changed, but because the emotional reward of participation has disappeared. This is how markets thin out crowds without dramatic events. They simply wait. Disciplined capital operates differently. It does not confuse silence with weakness. It understands that periods of stagnation often precede structural shifts. Large systems rarely move in straight lines or on short timelines. They compress, they pause, they rebalance internally. During these phases, visibility is low, narratives fade, and public interest declines. That decline is not accidental. It creates space for positioning without competition from emotional noise. What makes sideways markets so difficult is that they feel unproductive. Humans are conditioned to associate progress with visible change. When price does not reflect effort or patience, frustration sets in. This frustration pushes people to seek action as a way to restore a sense of agency. Ironically, this is when they are most vulnerable to making decisions that conflict with their original reasoning. The desire to do something becomes stronger than the logic of waiting. Over time, many participants exit not because they have concluded the opportunity is gone, but because they can no longer justify the emotional cost of staying. This is a subtle but important distinction. They are not making a calculated reassessment. They are responding to fatigue. Sideways markets exploit this vulnerability by stretching time until emotional tolerance runs out. Meanwhile, capital that is not emotionally dependent on daily validation remains. It understands that accumulation and distribution rarely announce themselves loudly. They occur when attention is low and sentiment is indifferent or negative. By the time movement becomes obvious, the quiet phase has already done its work. Recognizing this reframes the experience of waiting. Instead of viewing stillness as wasted time, it can be understood as a sorting mechanism, not a guarantee of future outcome, but a test of psychological alignment. Those who remain calm are not necessarily smarter, they are simply less reactive. They do not demand that the market entertain them. This does not mean ignoring doubt or pretending patience is easy. It means understanding that discomfort during inactivity is normal and expected. Sideways markets are not designed to reward engagement. They are designed to expose the limits of it. When you see that clearly, you are less likely to let boredom or frustration dictate decisions. In the end, these phases reveal who is positioned based on conviction and who is positioned based on emotion. The market does not rush this process. It allows time to do the work. And time, when combined with silence, has a way of redistributing participation from those who need movement to those who can tolerate stillness. One of the most persistent misunderstandings in investing is the belief that price movement is the primary driver of reality, when in fact, price is usually the final reflection of changes that have already taken place beneath the surface. Most visible price appreciation comes after positioning, infrastructure, and structural alignment are already well underway. By the time an asset begins to move in an obvious and sustained way, the conditions that made that movement possible have often existed for much longer than most participants realize. Markets are complex systems, not simple feedback machines. They respond to layers of preparation that are rarely visible to the average observer. Regulatory clarity, liquidity pathways, operational readiness, and institutional comfort do not appear on charts, yet they shape future behavior long before price responds. These elements develop slowly and quietly because the systems involved are cautious by nature. They prioritize stability over speed. As a result, there is often a long gap between foundational progress and market recognition. This gap is where frustration grows. Investors look at price and assume it tells the whole story. When price does not confirm expectations, confidence weakens. People begin to doubt the relevance of everything else because it cannot be measured in real time. This creates a false hierarchy where visible movement is treated as truth and invisible preparation is dismissed as hope. But historically, this way of thinking leads to late positioning, not informed decision-making. Long-term capital understands that price is reactive, not proactive. It waits for conditions to align, not for headlines to appear. It watches how systems behave rather than how markets feel. This is why it is comfortable positioning before clarity becomes popular. When price eventually responds, it does so because multiple layers have already shifted. The movement is not the beginning of the process, but the acknowledgement of it. This is emotionally difficult for individual investors because it requires trusting processes that cannot be observed directly. It requires tolerating a period where effort and patience do not appear to be rewarded. During this time, narratives weaken, attention drifts, and belief is tested. Many people interpret this as evidence that nothing is happening, when in reality the most important work is imply not visible yet. The danger of focusing exclusively on price is that it trains investors to chase confirmation instead of understanding structure. When price becomes the deciding factor, decisions are delayed until opportunity is already crowded. At that point, risk feels lower emotionally because everyone else appears confident, but structurally the advantage has already diminished. Recognizing that price lags reality changes how waiting is experienced. Instead of feeling like inactivity, it becomes a period of observation. Instead of demanding immediate validation, the focus shifts to whether the broader environment is evolving in alignment with long-term expectations. This does not require certainty, only awareness. This perspective does not promise outcomes. It does not guarantee that patience will be rewarded. What it does offer is protection from the most common psychological trap in markets, assuming that lack of visible movement means lack of progress. When investors can separate what is seen from what is developing, they reduce the risk of abandoning positions simply because confirmation has not yet arrived. In markets shaped by large systems and slow-moving structures, price will always be the last messenger, not the first. Understanding this does not remove uncertainty, but it restores balance. It allows investors to engage with markets without being dominated by them, and to wait without mistaking silence for failure. History shows that the greatest shifts in wealth rarely occur during moments of loud optimism or collective excitement. They unfold quietly during periods when confidence is thin, narratives feel tired, and attention has moved elsewhere. These are the moments when participation shrinks, not because opportunity has disappeared, but because emotional tolerance has been exhausted. When discouragement becomes common and enthusiasm fades, assets begin to change hands in ways that are subtle but significant. During these phases, many investors are not making calculated decisions to leave. They are responding to emotional wear. The ongoing effort of waiting, hoping, and explaining the decision to themselves becomes heavier than the position itself. Eventually, stepping away feels like relief. This relief is often mistaken for clarity, but it is usually the result of tension being released rather than insight being gained. The market does not require panic to initiate this transfer. It only requires time and quiet pressure. Patient capital operates without urgency in these conditions. It does not interpret discouragement as a signal to withdraw, nor does it view negative sentiment as a verdict. Instead, it recognizes that when confidence is widespread, opportunity is often limited, and when confidence is scarce, positioning becomes less competitive. This does not imply certainty of outcome, but it reflects an understanding of how human behavior clusters around emotion. What makes these periods so challenging is that they lack narrative support. There are fewer stories reinforcing belief, fewer voices expressing confidence, fewer signals suggesting that waiting is justified. Humans are social learners, and when collective reinforcement disappears, doubt intensifies. The absence of shared optimism feels isolating, even if the underlying structure remains unchanged. This is where wealth transfer occurs, not through dramatic collapses, but through gradual disengagement. Assets move from those who need emotional confirmation to those who are comfortable operating without it. The process is not visible on a daily basis. It does not show up in headlines. It reveals itself only later, when conditions shift and participation increases again. Understanding this dynamic reframes discouragement itself. Instead of seeing it as evidence that an opportunity has failed, it can be recognized as a common feature of transitional phases. Discouragement reduces competition. It lowers emotional noise. It creates space for thoughtful positioning. While this does not guarantee success, it does explain why the most favorable risk environments often feel emotionally uncomfortable. Selling during exhaustion is rarely a strategic choice. It is often an attempt to restore emotional balance. There is nothing irrational about wanting relief from prolonged uncertainty. The problem arises when relief is mistaken for resolution. Once emotional distance is achieved, perspective often returns, and with it the realization that the decision was driven more by fatigue than by new understanding. Recognizing this pattern does not require suppressing emotion or forcing patience. It simply requires honesty about what is driving the urge to act. When investors can distinguish between emotional exhaustion and structural change, they are less likely to participate in transfers that favor those with greater tolerance for uncertainty. Wealth does not move quickly when it is being transferred. It moves slowly, quietly, and without announcement. By the time outcomes are visible, the emotional work has already been done. Those who understand this are not immune to doubt, but they are less likely to let discouragement make decisions on their behalf. One of the least recognized advantages in markets is not access to information, speed of execution, or even analytical skill, but the ability to remain calm and restrained when conditions offer no emotional reward. Most participants underestimate how much their behavior is shaped by internal pressure rather than external reality. When markets feel slow, uncertain, or unresponsive, the discomfort that arises is often interpreted as a signal that something must be done. In truth, that discomfort is simply the nervous system reacting to a lack of stimulation and resolution. Urgency is rarely a sign of clarity. It is usually a sign that internal tension has crossed a threshold. When people feel the urge to act without new information, they are often seeking to escape uncertainty rather than respond to opportunity. This is why restraint becomes such a powerful long-term advantage. The ability to pause, to wait, and to allow conditions to develop without interference preserves alignment with original intent. Perspective plays a central role in this process. Short time horizons magnify noise. Small movements feel important. Minor setbacks feel decisive. When attention is narrowed to daily or weekly fluctuations, emotional volatility increases. Long-term thinking, by contrast, expands context. It reduces the significance of temporary stagnation and allows broader structural developments to take precedence. This shift in perspective does not eliminate doubt, but it prevents doubt from becoming dominant. Calm does not mean passivity, it means choosing not to confuse activity with effectiveness. Many costly decisions are made not because action was required, but because stillness felt intolerable. Markets do not reward constant engagement. They reward appropriate engagement. Knowing when to step back is as important as knowing when to participate. Restraint also protects against narrative fatigue. When investors are constantly exposed to opinions, forecasts, and interpretations, conviction becomes outsourced. Belief rises and falls with external voices rather than internal understanding. Over time, this erodes confidence and increases dependency on reassurance. Reducing reactivity restores autonomy. It allows decisions to be rooted in comprehension rather than consensus. This internal steadiness becomes especially valuable during long transitional phases. When outcomes are delayed and signals are mixed, those who can remain composed avoid the cycle of hope and disappointment that drains emotional energy. They conserve attention, they conserve judgment. They allow time to reveal information gradually rather than forcing conclusions prematurely. None of this implies certainty or control over outcomes. Calm does not guarantee success, and restraint does not eliminate risk. What they do offer is consistency. Decisions made from a regulated state tend to align more closely with long-term objectives. Decisions made from urgency tend to conflict with them. The ability to maintain composure in uncertain environments is not innate. It is developed through awareness and practice. Recognizing when discomfort is emotional rather than informational creates space between feeling and action. In that space, choice returns. Instead of reacting, the investor responds. Over extended market cycles, this difference compounds. Those who preserve clarity during quiet periods are less likely to make irreversible decisions under temporary pressure. They remain positioned not just in assets, but in mindset. And while markets will always remain unpredictable, maintaining control over one's own reactions is one of the few variables that can be managed. In the end, long-term success in markets is less about being right at every moment and more about staying coherent through uncertainty. Calm, perspective, and restraint do not draw attention. They do not create excitement, but they quietly reduce mistakes, and over time, avoiding major mistakes often matters more than capturing every opportunity.